probably one of the best teachers in option trading, Mark Sebastian. So I'm not going to take any of his time up. Let him just crank away, and this is a good place to learn different techniques to help your own trading. So welcome, Mark. We'll let you take it away.
Oh, thanks, Dave. Yeah, my name is Mark Sebastian. I run Option Pit, mentoring and consulting. We deal with retail traders, and we also do institutional consulting. I'm also involved in a soiree of other projects that I work on, from kind of hedge funds. I trade for my own account, and I do some research writing as well. But today, we're going to talk about trading the option pit method using volatility to trade direction. And so let's talk about this. So what you are going to learn, you're going to learn the value of mean reversion. All right, basic buy-sell option decision. All right. Then I'm going to briefly talk about what is delta. All right. And we're going to talk about hard and soft deltas and how to pick the best strike to trade. Okay? So, implied volatility. Let's start there. All right. What makes trading volatility different than trading a stock? All right. This is really important. And the answer is, over the long term, we know where implied volatility of a stock or index is going to go. All right. We do not know where stock price is going to go. You know, the VIX, which is the CBOE Volatility Index, all right, over the last 25 years has had a mean of about 20. And it always reverts back. When it's too high, it reverts down. When it reverts down, or when it's too low, it'll revert back. All right. Now, does that mean that the median or the mode number is 20? No. So one of the things you've got to think about when you're thinking about low versus high implied volatility in something like the VIX, the VIX really does have a lower bound. I've seen it trade intraday below 10 once in my lifetime. And I've also seen it trade over, near intraday into the 80s and settle above 50 for several weeks. So, it doesn't take very many occurrences of 50 to pull up a lot of occurrences of 15. So while the VIX may have a long-term mean of 20 that it will revert to, it has many more occurrences below 20. But that's a really important thing to be aware of, is that IV, the implied volatility, the insurance cost of an option, mean reverts. So, you look at Apple. This is Apple. All right. And this is from kind of end of November. All right. And if you look at this thing, look at like the 50 and the 200-day moving averages. Do either of those look like they are some mean reversion? You may say there's line reversion, but there's really no mean reversion. All right. Now I'm going to pull up VXAPL. All right. And the reason why I use VXAPL, I have some fancy schmancy software that I use called LiveVol Execution and LiveVol Pro. It's actually free and cheap to trade with. LiveVol Execution. LiveVol Pro you have to pay for. But VXAPL is the VIX of Apple and is readily available. Okay? So look at that 200-day moving average. Look at the way this moves over this 6-month period. I can pull up a longer period, and it hovers right around like 31. So the volatility of Apple options has a meaning. Apple itself does not. Does everyone kind of understand the difference there? If not, I will kind of answer questions about this at the end. I'm going to take like a middle break here in a second, just to make sure I get some questions. All right, mean reversion. A stock can go anywhere. All right, in 10 years, the S&P could be 20,000. The S&P could be 2. The VIX will probably be 20 over an average. All right, so volatility can go anywhere. It can't stay anywhere. All right, think about options as a form of insurance. All right, you get into a couple accidents in a short period of time. You know, I'm driving and I rear end somebody, and then a couple months later, I'm driving and then I sideswipe somebody and knock off their side view mirror or something. And both go to my insurance company. My rates are going to spike. And they're going to stay more expensive for a period of time. If I do not have any more accidents, my rates will eventually go down. Options are a form of insurance. You will see the exact same thing. All right? It must revert over time. It will fall back. All right? We all have our individual spikes, but in the end, we're all part of a big actuarial average when it comes to car insurance. All right? So understanding where implied vol is, where accident insurance is, all right, can offer some pretty nice buy-sell decisions. You know, when vol is really high, it's like going to surrounding states in the Louisiana area and selling flood insurance. When vol is super, super low, flood insurance right after Katrina. When vol is super, super low, it's like, that's like selling insurance right in front of Katrina. At that point, you might want to buy it, not sell it. What a horrible. I'll tell you, I went down to New Orleans a couple of times and did some housing work after Katrina. Just amazing, that thing. Amazing. Still shocking what they did, what happened. So anyway, moving on. So let's talk about how to get long. All right. When one wants to get long, one can sell puts or one can buy calls. And while there are people who swear you should never own premium, there are perfectly acceptable times to do both. Short puts. All right. A short put is long the underlying and short volatility. I would call it long delta and short vega. It is long the underlying and short volatility. It's short insurance premium. All right. Delta is kind of how it relates to the underlying. Vega is how it relates to the insurance premium. Thus, the trader is hoping the stock moves higher and IV comes in. What makes IV drop? Take a look. What makes that implied vol drop? A drop in realized volatility. All right. IV often drops because realized volatility drops. Thus, a short put is actually a play on lower realized volatility. The market not running around. So, when I'm selling a put, the way I like to think about it is I'm betting that an underlying isn't going to go down. A lot of people were selling puts in Apple at the 500 strike. Because they were betting, were they betting that Apple was going to go higher? No. They're betting that Apple wasn't going to break 500. Here is GLD. You can get this vol chart by looking at an index called GVZ. All right, and you can see some periods of time, where we've got expensive gold. It's up at 170. But look at the vol. You see that? Look how expensive it was here. And I sell like a 168 put. And I get this pop up. And look at the drop in volatility. I'm buying that put back rather quickly. Here's another instance where we get a pop in volatility, pop in the underlying. We say, you know what, this ball is a little expensive, so we sell it. Write it down. Now, generally speaking, I don't try to pick tops in vol. I think that is a mistake. I am a very smart trader. I am. I'm sorry. You can call me, people will say, oh, who are you to walk in here and say you're smart? I'm smart. I know. All right? But I'm not that smart. Okay? I'm going to sell or buy thousands and thousands of contracts. Despite how smart I am, when I was on the floor, I would have called my trade, the opposite end of my trades, retail paper or stupid paper. Or, not smart paper. So what I usually do is I want to wait for a big push in volume and a big push up in volatility, and then an easing of volatility on volume. Once volatility's been sold off a little bit, that's typically, when I'm looking to get in. All right? So a long call is kind of the opposite of that. It is long Vega and long Delta. So it's long the underlying. All right? And it's long insurance premiums. The trader is hoping IV goes up and insurance prices increase. So again, you're actually hoping that the stock is going to go up, not creep higher or sit. Thus, we want upward movement and an uptick in realized volatility. We're actually betting that a stock is going to go up. All right, so there's your first buy-sell decision. If you think a stock is going to go up, you buy calls. All right, if you simply think a stock is not going to go down, sell put. It's that simple. Here's some really good examples. This was the trade of the year in Apple. I was screaming at people to buy premium. I was actually buying straddles. And we see similar opportunities again and again in Apple. When Apple vol gets overly sold, the stock is going to move hard. You actually saw one here. This would have been a bearish trade, right? I typically buy straddles at these points. I'm not that good of a directional picker. But if you thought Apple was going higher, after that gap, after that major sell-off, this was the best time in the world to buy calls. One thing I will say is that typically Apple vol only gets to kind of these crazy low 22% levels when it stops going higher and people are doing what's called a buy right. So they're buying the stock and selling calls. And that's when the vol gets too cheap. And that's actually the best time to buy calls because you've got the whole market bullish in.
13, 125.
Bullish Apple.
3 m.
I forget. Bullish it sounds like something very different than bullish Apple, doesn't it? So you've got this long premium. You know, these opportunities just go in and get very, very long. Buying calls as opposed to selling puts. You sell a put, you get to keep the premium you sold. You buy a call, you know, you can really clean up. But you can lose that premium if you're wrong, if the stock doesn't move. So let's take a second and see if there's any questions so far. So the white is historical. The red is implied. Any other questions? What's the symbol for AppleVix? VXAPL. You can go on the CBOE. Yeah, so it's VXAPL. And you can get cheap historical vol data at iVolatility. And you can actually find that on almost any brokerage platform. So there are 5 main equities. You've got GLD has GVZ. Apple has VXAPL. Silver has VXSLV. What parameter determine if IV is relatively high or low? You know, you really don't need historical vol, but I like to know whether there's a reason that vol is high. You know, for instance, I'm going to go back to sharing my application real quick. So for instance, here's, this is GLD, alright? And you see that vol is really expensive. The red line is implied. The reason why I look at implied, at realized, is I like to know if there's a good reason. I like to see what is happening with the underlying and whether, you know, implied vol has a reason for being elevated. All right? Now take a look here. Take a look at this period here. You think that this was a good time to be selling options when realized vol was just sinking, and implied vol sank right along with it. Yeah. Yeah, it wasn't so bad. All right. So yeah, you're seeing gray boxes because I'm looking at the where do you get those nice vol charts? I use Live Vol X. You can clear interactive brokers. They're actually cheaper to trade than interactive brokers, and it's a better execution platform. You know, imagine this. It's got kind of the underlying of interactive brokers and a front end that probably puts every single, the gray boxes that I'm looking at, it's much better than Thinkorswim. Actually, Thinkorswim is kind of like I liken Thinkorswim to anybody here, if you like cars, I liken Thinkorswim to a really nice looking car with a 4-banger underneath. Whereas interactive brokers is kind of like a rusted out muscle car. I would say kind of Live Vol X is like a 911 Carrera. Super fast, super slick. Ivy, do we take 20 days, 90 days? I usually look at, you don't need to look at the slide right now. I'll go back there, don't worry. Ivy, do we take 20 day, 90 day? It depends on the time frame of your trade. So this is 30 day, Ivy. I usually look at 30 day because I'm a short-term trader. But if you're buying options at 90 or 180 days, well, you should be looking at 180 days. Okay? It really depends on your time frame, the IV you should look at. Does that make sense? Here, I'm going to reduce this so you're seeing less gray box. Cost is a four-banger. What about Trade Monster B? Probably about the same. At least Trade Monster is an internet platform, so you can use it anywhere. Total broker trading prices have historical implied volatility as an indicator. I have it as Schwab Street Smart Edge Pro. Yeah, I mean, there's some good stuff there. What about day trades? You could absolutely use vol for day trading. There are guys, I did a presentation on implied volatility as a sentiment indicator the last time I was here. I actually walked through VIX as a sentiment indicator. You can email me or you can email Steven and I can send that. Listen, I've only got one screen right here. I'm doing this from my house, so you don't need to look at the slide right now anyway, because I'm just answering questions. Is implied volatility a sentiment indicator? No, it can. I think it can be. I think its relation to how the market is moving is yes, but on its own, it doesn't really tell us a lot. You have to take implied volatility as a relative indicator. Does that make sense? All right. Why don't you have tennis? My office, I have a lot more screens, but I'm doing this. It's 7 at night here, and I wanted to put my kid to bed before this. Would selling calls after a big up move and no rise in IV make sense? It absolutely could. It absolutely could. All right, I'm going to move on. I'll hit more of these in a second. All right, so getting short. Like going long, when one is making buy-sell option decisions, one must take IV into account. So, when IV is high and one thinks the stock is going to go down or not go up anymore, all right, you sell calls. Right on with the previous person had. All right, so then when IV is low and one thinks the stock is going to fall, you buy puts. Very simple. I'll show you a couple of charts there. So short calls in Apple. Apple is consistently there's a reason people like buy writing. Interestingly, some of the times where you absolutely, right before you really, really, really want to buy premium, you take a look. This is my chart before. Notice the 3 times where I say these are premium buys. What do we see right before a lot of them? Clear, premium, sell. Those are good opportunities to sell calls. For sure. So here's puts. IBM, believe it or not, a lot of people like selling premium IBM. I found that to be a great one for targeted buying because it doesn't move very much, but when it does, it really does have a trend to it. So its volatility may be low. But unless you're delta hedging every day, calls or puts can be great. Now, one thing I would point out is, these are really timed together. Notice we get this big drop in vol here after earnings. 1, 2. You see we went from 207 to 200. All right, well, this was actually an excellent opportunity to step in and look at maybe buying puts, because you could buy a put here, lined up. Oops. Sorry, folks. You bought a put here, lines up right here. Well, take a look. How do you think buying puts on October 18th worked out for you? I remember this because I was sitting there talking to Andrew during the pit report. Andrew's my partner. And I said, you know, I feel like they've oversold Vol and App in IBM, and it might be, I think it could still move. Those are some ugly earnings. And guess what? This is a great put purchase. Would have been a great straddle purchase. When volatility gets cheaper, but notice, I'm almost never buying on the absolute peak or pointing. There's opportunities to buy, even after this huge move. You could have bought a put and been a nice winner. Picked up about 5 handles. Same thing here. Vol picks up a little bit here. Not trying to buy the bottom. You think we're going down? Could have picked up about 7 handles. And for IBM, the symbol is VXIBM. All right, so now let's briefly talk about what is delta. All right, delta has several definitions. However, the one most commonly used is it's the correlation of an option to its underlying. So an option with a positive 0.6 delta, sometimes called a 60 delta, it will make 60 cents for every dollar the underlying rallies. All right, it will lose 60 cents for every dollar the underlying falls. So if that was a negative 60 delta or a negative 0.6 delta and the underlying rallied a point, that option would lose, well, what's 1 times negative 0.6? 60 cents. And vice versa. Okay? Real brief. Any questions on that before I move on? It's brief but important. They have, LiveVol has intraday charts that you can use. Volatility can increase while underlying goes up. Absolutely can. Is IV a leading or a lagging indicator? Typically leading. Yes, there's no video output right now. That is correct. There's nothing to look at. Yes, shoot me an email. I'll send you the slides. I will have the screen right back. All right, I'm just answering questions right now, making sure everybody understood delta. Any questions on that? It's usually leading. I mean, it can lag, but it's usually leading, but it can lag. I mean, volatility is a dense subject. I mean, generally, it's meant, people view it as a leading indicator, but it does sometimes lag, is the way I would put it. Can this work on indices? Absolutely. Last time I was here, all right, I absolutely showed what I was doing. All right. All right, everybody's back, huh? All right, so now let's talk about deltas. How to trade direction. And this is really where volatility shows its teeth and why you need to know this stuff. As professionals, we use a term called a hard delta and a soft delta. All right? Unlike stock, stock is always going to be stock. All right? What is the difference between a stock and how an option can move? All right? Well, we're going to talk about that. All right? A hard delta is relatively resistant to changes in volatility. A soft delta is relatively dependent on a change in volatility. Understanding the difference can help with strike selection. So let's talk about hard deltas. All right? A hard delta is a delta where even if volatility goes up a lot or down a lot, the pricing model is not going to change your delta very much. Okay? Are we all aware that the pricing model, delta, is an output of that model? All right? It's not a set in stone thing. If I raise volatility on an out of the money option, its delta will increase. If I raise volatility on an in the money option, its delta will decrease. All right, so now let's talk about a hard delta. When would you use a hard delta? All right, when one isn't sure of an IV's future movement. When IV is very, very high. All right, when one isn't sure of the severity of the expected move, but wants to have limited risk. So here is Goldman Sachs. All right. You can see they have a plunge in volatility. But the underlying rallies from 115 all the way up to about 122. So we get a nice rally in the stock, but the vol tanks. So what option, if we thought Goldman Sachs was going to rally, what trade might we execute? Well, here's 11:15, the beginning of the move. You can see that. If we bought calls at the beginning of the move, let's take a look. All right. We pay $7.50 for one 110 call. All right. And we pay about let's call it $2.20 for three 120 calls. You know, you can take 3.5, but let's just, I don't want to get too lost in the details here, folks. All right, so now let's look at 11:23 and notice what's happened. All right, we make about 85 cents 3 times. If you want, I could do 4. I'll do 4. Okay, so we spend about $8.80, and we make 85 cents, or 87 cents, well, 85. I'll do 90, whatever you want. 90 cents, about, 90 cents 4 times. That's $3.60. We spend $7.50, and we make $3. All right? We spent less and made about the same. Not a bad trade. Okay? If you look at the 125s, the scenario gets even rosier for us. Okay? How many times does 90 cents, 92 cents go into 7.5? I'll tell you in a second. I'm pulling up a calculator. 8 times. All right. So we have 8 of the 125 calls for 92 cents, and they go up to a screaming 115. That's 23 cents. What's 8 times 23? $1.84. You can see the 120s, which are now a little in the money, are about break even. The 125s are huge losers. In the case where vol was elevated and we thought it might drop, we wanted the harder delta. All right. Now, let's talk about soft deltas. Soft deltas are more sensitive to IV changes. And there's some very specific times where they can make a lot of sense. All right. When IV is really low, when we're expecting a crazy move. All right. When we want to make a very cheap bet. Or some of these two of these three typically. Here's IBM again. All right. IBM at some ridiculously low level. Let's take a look here, guys. On 11/21, we can buy an IBM 185 call for $6.75. 2 days later, it's worth $9.25. So we make $2.50. All right, now, not bad. Hey, certainly better than a kick in the stomach. All right, but let's look at what happens with the 195 calls. Look at the implied volatility move. All right, and so the deltas stayed. Those soft deltas got to help. And so, we'll call it 120. How many times does 120 go into 670? 5.5 times. I'll do 5 times for giggles. All right, 120, it's now worth 220. What's 5 times 220? $500. 5 times a buck. $500. So we make $500 on the same amount, on actually fewer dollars than we do buying the in the money. We wanted the soft delta because implied volatility was just dirt cheap. And yes, these absolutely apply to intraday. Vol, if I pull up an intraday chart, I'll actually pull up an intraday chart after this, and I'll show you what it can look like. Okay? All right, so now, here's a little quiz. XYZ stock is at or near, at a near all-time low in IV terms. And at the same time, the stock is peaking out. And realized volatility is increasing. All right. The trader wants to get short delta. In what order would a trader choose to get short delta? All right. So, stock is near an all-time low. The stock is near an all-time low in IV. Stock is high, and realized IV is increasing. Do I want to sell in the money call? Sell 3 out of the money call? Buy an in the money put, or buy 3 out of the money puts? What do you think? Traders? What do you think? I think my phone's ringing. You guys get these calls from toll free, and you're like, why are you calling me? All right. So what do you think? All right. I'm gonna give everyone a minute to answer, and then I'll answer. All right. In order. All right. The first one, this should have been easy, is I'd rather buy 3 out of the money puts that are 25 delta. That's my number one choice. Is number 4. All right. The next option that I would go for is probably the one in the money put that is a 75 delta. The next option I would go for, so far we're 4, then 3. Then I would go to sell one in the money call that has a 75 delta. Why? When vol's low, I want that hard delta if I think the IV is low. And the stock's going to go down. And then finally, I'd want to sell 3 out of the money calls. So the order is 4, 3, 1, 2. All right, so summary. Belief in mean reversion is key. When IV is high, we sell it, use harder deltas. When IV is low, we buy it, use softer deltas. Now I want to quickly give you the deal of the year for you guys. My silver course, which is an options fundamental course, all right, goes through reversal, conversion, covered calls, and buying protective puts, and collars. All right? We normally sell it for $149. It comes with 1 month of my Option Pit Live service that comes with a daily 45-minute live market discussion and our Option Pit strategy letter that goes out and follows along with trades that it has had a remarkable annualized return so far. Not saying it's always going to be that way, just so far things have been really good. All right, you go to you can see the where you go right here. I'll drop that link in, and for $19, how can you lose? All right, and again, now, when you sign up, it is going to sign you up for an ARB of Option Pit Live, because after that it goes month to month. All you have to do is email me and say, Mark, I'm not interested in more months, or call me, or you can go into your account and cancel yourself if you're computer savvy, which is, actually, you don't even need to be computer savvy. You just need to, take 2 minutes to update your profile. All right? Now, what defines hard versus soft delta? How sensitive it is to volatility. Usually, a deeper delta will want it. How do you know beforehand about delta will become soft or hard? You don't know whether it'll be soft or hard beforehand, whether it will stay that way, but when volatility is elevated, all right, when volatility is elevated, typically speaking, you know that out of the money options are more likely to be soft deltas, and in the money options are more likely to be hard deltas. We got a bunch of, all right. So we got a few questions here. All right. Implied volatility is a measure of how traders are bidding options. It is derived from prices that traders set in the market. It is not something calculated in a computer to create prices. It's always derived from trading. Traders are putting up calls anticipating bullish in the underlying implied volatility will go up. That is true, But sometimes calls or puts get bid up in reaction to a stock move. All right? So you will actually see the stock move prior. So there are some times where implied volatility can be a lagging indicator. Hard delta has a higher intrinsic value versus time value. That's correct. How do you, all right, what price is IBM in this example? I gotta go back and look. 185 apparently. All right, so let's see, what other questions do we have? Out of the money, 30, 25 delta, 30 delta. Those are really good. I typically don't mean a very, very way out of the money cheap option. All right. How do you know beforehand a delta will become soft or hard? The vol. You're betting on the volatility. It's hard for us to predict direction. Volatility can be easier to predict. All right. Can you give some tips on trading VIX options? Thanks. You know what? We go through this all the time. The big thing to understanding VIX options is it a one-time webinar? It's 9 one-hour webinars or 9 45-minute webinars. And you get to keep those for life. So the big thing about VIX options is you have to understand what the underlying is. All right? What is the underlying to VIX options? What is the minimum amount of cash needed to trade options? That depends on you. Time expiration will affect hard versus soft for sure. The further out in time you go, the softer every delta gets. All right? But volatility matters way more in leaps than it does in anything. Never buy crazy expensive leap vol. So is it more intrinsic value relative to extrinsic? Yeah, I think so. Would you need to buy a spread when selling naked calls? Yeah, you might. Oh, when are the 9 webinars? They're recorded. You get to keep them. So they're pre-recorded, those webinars. So those are pre-recorded. And I told everybody that I will I'm going to briefly show you what an intraday chart looks like. So yeah, they're all recorded. What level of vol in an option would you say is high? 65, 75, what is cheap? Every stock has its own volatility. So for instance, in Apple, I would say anything below 20 is cheap. In IBM, anything around 15 is typically cheap. Anything above 25 is expensive. What's the minimum amount of cash to open an option account? I don't know, a couple $1,000. No, I did not say never buy leap options. Just don't buy leap options when volatility is super, super expensive. So, something like I used to trade in a biotech called Seprecor. They ended up getting bought out, but when it was its own individual stock, we considered 50 vol to be cheap and 70 vol to be expensive. So right now, I'm going to show you this. I'm going to show you this application in a second here, guys. We'll take a look at a couple of different. All right, some of the stocks we've been trading have IVs around 40 to 60. Yeah, that can be great. Do you buy vertical spreads or just buy calls and puts? I do all of the above. Vertical spreads make a lot of sense when you have no idea what the volatility is going to do. Okay? All right, so I'm going to share a little application here. Oh, forgot an E in my name. I was wondering what was going on here. All right, so this is the little tool I use. So let's pull up something like Apple. And you can see on Apple, I'll use my intraday charts. Here's my intraday. All right. But Apple actually, I can pull up one-day charts and follow along with different volatilities. This is Jan options. You can actually see the vol does in fact move. It can make big moves. I'll bring up a crazier stock. Anybody ever heard of Herbalife? So let's take a look at what happened with Herbalife today. Oops. Let me X that out. You can actually see the volume. Look, volume spike, volatility goes into the, look at volatility start to creep higher here on this big volume spike. Guess what you do here? You buy calls. Boom, 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 boom. All right, even in this big tanking here, hopefully you got out here or here. Well, even in this big tanking, you get a little more pop here, and you make a lot of bang for your buck. All right, and you see kind of another volume spike right here. This might have been a put sale opportunity. I don't know. This is a 2-day vol chart. So yeah, I do look at this stuff. On my computer at work, I'm running about 5 of these constantly. Whatever stock I'm looking at, and then S&P, gold, Apple, and VIX. Oh, the screen is gray. Sorry. Here, I'll just show my monitor. All right. So here is the Herbalife tick chart. Sorry about that, folks. So here's a 1-day chart for Herbalife. You think there's some opportunity to trade volatility here? Let's see. The range goes from 98 to 88. So a 10-point range. If you had, on this big volume surge, this was an excellent opportunity to step in and buy calls or buy options. All right. Other stocks that moved today, we can look at like FDO. I mean, look, the vol was crazy high as it was tanking. Then look, we kind of get a rally back. And look here, this is kind of the sign right here that nothing's happened for the rest of the day. Sold, or buy an iron butterfly, or sell an iron butterfly, buy a butterfly. Do something. Sell a call spread. You guys see that? So you're playing your trades around current month volatility. The volatility must be in line to trade butterflies, calendars, verticals. Absolutely. Absolutely. I would never trade an option without looking at what the volatility of the option was first. Sorry about the screen. My bad. People cursing me out. Sorry. Is this covered in my silver course? No, But the silver course comes with 1 month of Option Pit Live. And we talk about this every day for 45 minutes. And then, hopefully you'll, obviously I'm not selling you a $19 course to make myself rich. We offer other packages. What about the triple ETFs? They all go to zero. Do you short them often? Well, let's see, if triple ETF is going to zero, what do you think I do? Yeah, is there another dimension understanding IV and its relationship with the underlying? Yeah, because then you get into kind of term structure. Mark, is there a guest login and password to take a look at LiveVol Pro? Yeah, talk to them. And actually, you can get LiveVol Pro comes with LiveVol X, which is what I use. LiveVol Pro is a free site. It is not a free site. My students get a special discount on this. Or if you use LiveVol X, it comes free. But generally speaking, it's about $250 a month. So yeah, I mean, I'm using these intraday charts all the time and the intraday charts a lot as well. I use some cool scanners. But, you have to really understand the tool. You have to know how to drive the tool before you use it. LiveVol may be a nice pro equals pay. That's correct. Are weeklies too short of a time for your strategy? No, weeklies have volatility that matter. All right? Absolutely. Weeklies, implied vol in weeklies is super important. About the only time where volatility doesn't matter is the last 2 hours of expiration. All right, so I'm going to drop this one more time in. 19 bucks, how can you lose, right? It is sophisticated data. It's worth a lot. Nah, I don't think so. All right, any other questions about the presentation today? LiveVol Pro is nice, but you have to know how to use it. It's just like an airplane, you can't fly an F-22 Raptor unless you're a pretty good pilot, right? What is the daytime phone number for myself? What is the daily schedule on my site? Well, at 9:50 in the morning, at 9:50 in the morning Eastern time, I do a daily report for about 10 minutes where I cover volatility. Then the pit report is done live at 1:15. Throughout the day, we do individual mentoring, and we offer kind of group classes. Our gold class is one of the best classes in the world. We charge $1,900 for that, and you'll get more out of that course than you will paying $20,000 to $20,000 to Invest Tools or Optionetics or some of those ridiculous places. Yeah, my phone number is 773-969-4667. That's my office number. Anna, my assistant, will answer, or maybe I will. It is, the coupon code is CSVOL. That's Candlestick Charts Vol. CSVOL. All right, so yeah, my cell, you guys need to call me. No, it starts right away. But, I would suggest watching the webinars as well. Starts right away. We'll see you, and make sure you drop your phone number so that Anna can give you we don't require a phone number. It helps us so that Anna can give you a site tour. Oh, sorry about that, guys. Let me stop. Do I trade futures options? Sometimes. Mostly for, yes, I am in Chicago. Feel free to have, I have a general rule, and for if they haven't spent a lot of time in Chicago or New York, they're probably not worth listening to. I only say that because I know that Steve spent a nice piece of time in New York and Chicago. I use futures options mostly to trade like short time spreads. So something like S&P futures options, I'll trade them back and forth. You have to use futures options for things like corn or oil, things like that. Chicago, the murder capital. It is. It's also the capital for murdering trades. Mark, I am fully booked for January. No kidding, but we'll look for this offer in February. Thanks. Oh, I'm sorry. The offer is going to end on January expiration. So we only leave these out there for a short period of time. What you can do is if you're totally booked, what broker do I use? I use about 5 different brokers. Mostly I use LiveVol though. LiveVol, I use TradeMonster, I use Thinkorswim. I try and make myself familiar. What if I can't start? We'll move that 1 month when you start happily. All right, you just need to get your order in. All right. Do you ever use VXX calendar spreads? Absolutely. We are directional traders. Would you recommend trading directionally if vol is not overbought or oversold? Sure, if you know what you're doing. So we can start our trial in a couple of weeks and sign up now. Yeah, I mean, you give us our office a ring. What is my email? My email is right there. Give me an email, give me a call, and we'll kind of move things around. It's not super simple. So Anna actually has to, if you're not going to planning on starting right away, Anna has to rejigger things. So make sure you give us a phone number. All right. Any other questions, guys? When high volume came in HLF, it told you to buy calls, but when high volume came in FDO, you said it was time to sell some calls. What was going on? Well, the high volume matched with the move in volatility. All right? That was the big difference. So, one, the vol was rallying in high vol. That means vol's going higher. And then the other one, vol was tanking on high volume. There you go. All right, everybody. I'll give you our phone number one more time. I want to 9694667. My email is mark@optionpit.com. Here's the link. And remember, it's CS vol or candlestick volatility. You can think about that if you can't remember. All right, guys. And I'll happily email you my presentation. I always go out of my way to try and give a lot of stuff when I do these presentations. I never repeat my presentations exactly. I always do something different. Thank you, guys. I hope everybody has a nice evening. I'm going to go enjoy myself a cool glass of Cabernet.
Thank you very much, Mark. Very interesting.
You know what I mean.
And
have a good night, everybody. Thank you.
Yep.
You
have a
are
good evening.
A gentleman and a scholar.
All right. We'll see everybody in the chat rooms.